Hello everyone, I am Professor Nikhil Verma, and in the previous video guys, we solved an illustration on capitalization of average profits, and we had also discussed that in the next video that we are going to launch, in that video we are going to discuss super profits. But I got a couple of requests from students asking me to solve one more problem on this method as well. So I have taken another illustration on the same technique, which is capitalization of average profits. So we will solve this problem today, and from the next video we are going to start super profits. All right. So let us just go through the problem. Again, ascertain the value of goodwill based on capitalization value of Okere Limited. So the name of the company is Okere Limited. We are supposed to find out the value of goodwill using capitalization of average profit method. So they have given us the balance sheet here, and they have given us notes to balance sheet. All right. See, in the balance sheet, we have note number 1 and 2 in the liabilities side, which is share capital and reserves and surplus. In share capital, we have equity shares alone. And in note number 2, we have P&L account credit balance. Then we have other liabilities, which is outside liabilities given as bank overdraft, sundry creditors, and provision for income tax. On asset side, we have goodwill as intangible asset. Then they have given us two tangible assets, land and building, plant and machinery. Then we have current assets as stocks and book debts. Book debts is nothing but debtors. Then we have some additional information here. They have given us profits of 5 years, and they have told us that the income tax is charged at 40%, which is yet to be charged on the profits mentioned above, and the normal rate of return is 12%. So let us start solving the illustration. We are going to use both the approaches, which is net assets approach and liabilities approach. The formula to calculate goodwill under net assets approach is capitalized value of business minus net tangible assets. So guys, the step number 1 is calculation of capitalized value of business. The formula to calculate capitalized value of business is future maintainable profits, which is nothing but average adjusted profit, into 100 divided by normal rate of return. Normal rate of return is given at 12%. We'll have to find out future maintainable profits. I've already drawn the table here for your reference, which was discussed in the previous problem as well, how to use this table. I had given you all one more method, which is easier one, but I prefer this because here you can inculcate any adjustment that is given in the problem. But for the other method, there are limitations. You can only use that method when you have such adjustments which are applicable to all the years. All right. So let us find out the future maintainable profit by taking the profits of each year. Is 3 lakh rupees for 2014. For 2015, it is 3,75,000. For 2016, it is 4,25,000. For 2017, it is 4,75,000. And for 2018, it is 4,25,000. Right. Now that we have the profits, let us calculate income tax. Income tax is payable at 40%. So let us find out the income tax on each of the year. I'll copy paste this formula. You will have to find out 40% of the profits of that respective year. So we get 1,20,000, 1,50,000, 1,70,000, 1,90,000, 1,70,000 as income tax. Now we will subtract income tax from the profits. Let us do that. Do that for all 5 years. And then find out the average, guys. Take all the profits, adjusted profits of individual year and divided by number of years. So sum of these 5 divided by 5. Okay. So the average that we get is 2,40,000. Using the above mentioned formula, we will take the FMP, which is 2,40,000. We will multiply it by 100 and divide it by 12. So I'll do that again. See this formula here. G15 is this cell. So we take G15 is 2,40,000. So 2,40,000 into 100 divided by 12. Let us do that again. See here. 2,40,000 into 100 divided by 12. That is the step number 1. If you look at the formula of goodwill, we have found out CVB. Now we'll need to find out NTA. NTA is net tangible assets. That will become our step 2. Let us calculate that. Okay. So we'll have to take all the tangible assets and subtract it with outside liabilities. We will see the question here. Asset side, we are going to take all the tangible assets. In order to take the tangible assets, we'll have to see note number 3. So we have land and buildings and plant and machinery. Let me write that down. Land and buildings and plant and machinery. Value of land and buildings is 5,50,000. Plant and machinery is 5 lakh. Okay. Then intangible fixed assets we are not taking. We will not take goodwill. Then we will take stocks. Stocks is valued at 7,50,000. And lastly, we will take book debts, otherwise known as debtors. We'll take that as 4,80,000. The total is 2,28,000. Total assets. Okay, total tangible assets rather. Now we will do less outside liabilities. Here, outside liabilities is what I had told you in the previous video. Anything apart from shareholders fund is outside liability. So shareholder fund has these two aspects. So we will leave the share capital and the reserves and surplus. Everything else is outside liabilities. In this case, we have 3, which is bank, overdraft, and we have sundry, creditors, and we have provision for taxation. Bank overdraft value is 2,40,000. Creditors is 4,02,500, and provision for taxation is 2,12,500. The total of outside liabilities is 8,55,000. Now we will subtract the total tangible assets with the total of outside liabilities. We get 14,25,000, guys. Okay. So this becomes our net tangible assets. Now we will find out the value of goodwill. Formula is capitalized value of business minus net tangible assets. We have calculated both. So first, let us take the capitalized value of business. It is here. It is 20 lakhs minus 14,25,000. So we get 5,75,000 as the value of goodwill. Okay, that is using net assets approach. Now we will calculate using actual capital employed approach or liabilities approach. The formula for calculating goodwill under this approach is normal capital employed minus actual capital employed, NCE minus ACE. The formula to calculate NCE is FMP into 100 divided by NRR. This formula is similar to this formula here. So we are going to take the FMP from here itself. We are not going to do it once again. Okay. But you guys might have to do it again in exams. So let us take that 2,40,000 into 100 divided by NRR, which is 12. So I just substituted the value of FMP in this formula. So we got 20 lakhs once again. ACE is shareholders fund minus goodwill. ACE is actual capital employed. So let us find that out. Shareholders fund, we have two working notes under shareholders fund. One is share capital and other one is reserves and surplus. So under share capital, see here, we have equity shares, and under reserves and surplus, we have only profit and loss account credit balance. So we don't have sub points under those notes. We can directly take the amounts from the balance sheet. 12,50,000 plus 3 lakh minus the value of goodwill. Goodwill is valued at 1,25,000. Look at the balance sheet. See. With this, we get the actual capital employed at 14,25,000. Now we will find out value of goodwill. The value of goodwill is NCE minus ACE. So 20 lakhs minus 14 lakhs 25,000. We get 5,75,000 as our value of goodwill. It's a pretty easy problem, guys. It is usually asked, one of the methods is asked for 5 marks. If both of them are asked, rarely asked, but if asked, it will come for 15 marks. All right. Thank you, guys. In the next video, we will focus on super profits, which is the most important aspect of this particular module, which is valuation of goodwill. Thank you.